Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Friday, September 5th. We are coming off the back of a Labor Day holiday in the US, and Labour is certainly on everyone's minds. We have Labour statistics coming out today, Friday. There is going to be a lot of focus on that, as a suggestion is likely to be that the Labour statistics will dictate the direction that the Fed takes in its meeting later on in September. And then we have to also remember that we're still coming off the back of the firing of the head of the Bureau of Labour Statistics. So we have to ask ourselves, well, what relevance could these labour statistics have and how much trust can we have in them? So as usual, I'm going to share the slides and we'll kick off today's podcast. I've called today's podcast Labor Day Reflections. We are coming off the back of the Labor Day holiday, as I suggested, and Labour is certainly on everybody's mind. As usual, we're going to cycle through inflation and a little bit of a vibe check on the economy. We're going to look at interest rates, geopolitics, equity markets, and in this case, we will be looking at the pretty substantial rise in the gold price this week and what that means in terms of trust and confidence. And more broadly, we'll be looking at the concept of trust and confidence and why that is so important, not only in the public sector when it comes to governments and trust in the fiscal policy, but also in the private sector when it comes to CEOs. Jobs, as I said, are in focus. Bonds are busy, and we'll speak about some of the dynamics that are driving not only bond yields, but also the default rates. We're going to look at the month of September, which is traditionally a fairly fractious and volatile month for equity markets, and look at some of the indications there. And as I mentioned, trust and confidence certainly on everybody's mind. When it comes to jobs being in focus, we've spoken before about this being a fairly low growth, low volatility market when it comes to jobs. There has not been particularly exciting numbers when it comes to jobs being created, jobs being lost. The unemployment rate is still pretty significantly below 5%. It's between 4 and 4.5%, so nowhere close to recession levels. And we have the job creation change in payrolls month on month being fairly subdued, but ticking up a little bit. That is what has been described in this chart as an uninspiring US labor market. So bearing in mind that, as I mentioned before, there is going to be a little bit of lack of trust in some of these statistics, it's still considered that these statistics will dictate the direction of the Fed later in September. So quite a bit of focus on these labor numbers as a vibe check, a sense check on the economy. And the Fed is clearly facing this bit of a balancing act. We've had the drumbeat of inflation being higher than expected. This was very much pronounced in the UK. We had a 3.8% inflation figure in the UK, clearly well north of expectations, well north of that 2% target. And we know that the Fed, because of this failure of services to become more subdued when it comes to inflation, we know that tariffs and their impact are slowly making their way through the economy. And anecdotally, we are hearing kind of a drumbeat, as I mentioned, of the fact that inflation is nowhere near as subdued or as in check as consumers would like, and certainly as policymakers would like. Well, interestingly, this has now been reflected in inflation-sensitive assets. We've seen these rising in the terms of gold, we'll speak about that later, in commodities as well as value assets, which tend to be inflation-sensitive as they are seen as being a good kind of source of yield in the course of inflation, and certainly really rising in line with inflation. So as these inflation-sensitive assets have risen, not necessarily growth assets rising, growth assets have seen a bit of a correction. That is going to put pressure on the Fed, that investors are essentially voting with their feet. They know where the investment is necessary in terms of keeping inflation hedging, and that is putting some pressure on the Fed, therefore, not to get too carried away when it comes to their rate cuts coming up later in the month. Then again, looking at some of the drumbeat around bond markets and some of the busyness you can see there, well, certainly we still have this drumbeat, as I mentioned, of the independence of the Fed. We've seen Lael Brainerd speak out to suggest that the independence is under attack. We know that there is still a case being litigated in terms of Lisa Cook and whether the president has the authority to fire her for cause, as he has publicly stated he has tried to do. And equally, we do know that there has also been a public statement about him getting a majority of Fed governors, a majority suggesting, therefore, that they would support a cut. And that would be this loss of independence that has been touted as being perhaps a seismic change for the separation of powers and for just the credibility of the institution. Goldman Sachs, according to the Financial Times, is on record for suggesting that the gold could hit nearly $5,000 if Trump undermines the Fed. They suggested that would erode the dollar's reserve status and extend the precious metals rally. Furthermore, when it comes to debt and where we are projecting, we do know that tariff revenues are projected to be an offset to the debt load, in the sense that they will actually enable repayment of some of that debt. But the debt load is projected to reach 150 trillion by 2055. So a mounting debt load there, a mounting interest burden, and that will be in some ways offset by tariff revenues, but certainly a kind of a pressing some pressures on the fiscal situation, and something that certainly investors are looking at. And furthermore, that the bond investors are now counting on this tariff revenue to rein in the debt, that the levies are seen as a way to offset the tax cuts and keep a lid on government borrowing. So a lot rising there on the tariff revenues. And even though there is clearly concern about this fiscal position, there's a hope and expectation rising that this will not get out of control, the rising amount of government debt. What other busyness are we seeing in the bond market? Well, we've spoken before about junk bond yields and the fact that they are now near historic lows. That would suggest that there is a confidence in the issuers of junk bonds, that the fact that these yields are not trading at any reasonable spread relative to the risk-free rate suggests that there is a confidence in the credit worthiness of these issuers, and overall in the sense of strength in the economy, that these issuers are not on the brink. There has been some suggestion that the reason for this relative strength in the junk bond market is that the less credit-worthy issuers and perhaps the more precarious credits are now issuing debt not in the junk bond market but in the private credit market, so that most of the risk has essentially been shifted there, and that maybe that today's junk bond market is not directly comparable to the junk bond market that maybe prevailed 10 or 15 years ago. So if that's the case and we're not comparing apples with apples, maybe we can't read much into these low spreads, but it is nonetheless notable that the bond investor, which is known to be perhaps more focused on the negative, more concerned, is not necessarily ringing an alarm bell when it comes to junk bonds. And that would be a relatively positive and salutary development for the economy. Looking, on the other hand, at the longer end of the curve, we can see that this expansion in yields and the sell-off in long-dated government bonds is very much a global phenomenon. We can see that is happening in Japan, Germany, UK, and the US. And certainly in the UK, that's where the UK yields have risen the most. This is deemed to be the fiscally fraught four. And Bloomberg has added France to that mix. We know that the French political situation has been driving a lack of confidence in the last week in particular, and that's been suggested as a reason for those bond yields gapping out. Why is the UK still an outlier, and why are their yields, at some point they had breached the level they'd been in 1998, and they'd gone even higher in the last week. They now have come in somewhat, but the UK, of course, is not tethered to the ECB's rate, which is at 2%, the Bank of England's rate's at 4%. So we have to look at them with a different anchoring there. So we are seeing this expansion of bond yields. Clearly, this is a global phenomenon, a global lack of confidence, and governments are reacting in kind. There is a temporary measure that governments can do when they see that their 30-year yield is at these levels. They can switch instead to preferring to issue shorter dated paper and take advantage of the lower yields at the shorter end of the curve. This would definitely lock them in to a less punitive interest rate. The problem being, of course, that if it is shorter dated, they would have to refinance that in shorter order. So they're essentially putting the pressure on themselves to get the fiscal house in order in a shorter time frame, and cannot take advantage of long dated yields that are lower, as we would have seen perhaps during the lower phase 5 or 6 years ago. So clearly, definitely a fraught fiscal situation being experienced globally, but not necessarily only in the UK. Moving to default cycles, we've also spoken quite a bit about the fact that default cycles that default rates are nowhere close to what they were at in 2008, when we had about a 12% default rate in high yield bonds. You can see that the 30-year average, according to this chart, is just south of 4%. We are still experiencing a default rate higher than that currently, it's around about 4.5%. So it's a little bit higher than average, but nowhere close to crisis levels. So I think it is notable, though, that we have for some time been experiencing this default cycle, if we call it that. It's slightly higher than average, which is now looking at a longer cycle than we've seen in other so-called crisis periods. The subprime crisis was well below 24 months, 08 to 2010. And looking back at other crisis periods, as this chart shows, the oil collapse 2016, 2017, and the COVID pandemic, we did have default cycles. We would call this a default cycle, even though it might not feel nearly close to as serious as the one during the subprime crisis. But it is notable to say that this phase of defaults being higher than the average has been persisting for longer than even during the 08 crisis. So this is getting in line with what we've said is more like a slow bleed. We haven't seen any single spark or single collapse to set off a cascade of defaults, but we are seeing just a general sense of malaise, a general sense that there's slightly higher than average defaults, and there's nothing necessarily that would stop that cycle. It's interesting also to look, this chart shows the industries where we have seen the defaults of a higher than their weighted average. And currently we are seeing a higher level of defaults in, if you look at the orange bar, which is the 2024 default rate, and the weighted average from 1981 to 2024, so 40 years worth of data there, we can see that leisure, the default rate in leisure is higher than its weighted average. The same for telecommunications, consumer, forest products, health, high technology. It's essentially almost every sector, with the exception of energy and natural resources, is currently at a higher level of default than their weighted average. So this would be in line with some of the thinking we've been seeing, that most of the good days and the kind of very positive news around the economy seems to be focused around the tech sector, and that other sectors, particularly services that are struggling from the inflation constraint, services are, these might be experiencing more frailty than might otherwise be suggested, and hence the default rate there being higher than average. So not making headlines, but just a kind of an indication of some of the slow weakness across some of these sectors. And if we look at what equities face, we can see that they do face September, but equally the past 3 months have been quite robust when it comes to equities. We've spoken about new highs being hit. We have seen a little bit of weakness in the just in the recent few days. September is traditionally a rocky month. If we show this chart showing the percent index change in September, going back, we can see that between 2018 all through COVID, and with the exception of 2024, September was a tricky year for equity markets. It's been historically the worst month for return in the past 3 decades. No particular science behind that. Maybe it is coming back from the summer malaise and a bit of preparation for taking profits at year end. JP Morgan clients have seen a weekly shift to short positions, among the biggest in the last 5 years. So a bit, again, a focus on perhaps concern around these new records being set. And we can also see a stall in the S&P in terms of its rally around its August record numbers. This was a 4-month rally that we saw ending in August. So perhaps time for some taking stock there. And again, if we look at how ultra long bonds typically perform in September, we can see that September has typically been among the worst month for 10-year government bonds. So that, again, completely in line with what we've said in terms of the gap out of very long dated government bonds. September overall, not a great month for sentiment. So I would just leave that maybe as a dose of caution as we look into September going ahead. Otherwise, there's been a surge in trading volume, and this has been certainly very salutary and positive for the banks. We're seeing other market making firms such as Citadel, Hudson River Trading, Jane Street, again, showing very strong trading revenue. What's behind this? I think there is a technical factor around the surge in algorithmic trading and more trading around these positions. We've also seen a pretty healthy participation by the retail investor in markets, and that has been driven by a hunger for yield, a craving for growth, and the sense of FOMO that has really persisted. So positive news for the banks that trading is where we are, and a lot of that, I believe, being driven by the very strong development in equity markets. Moving to a softer side of things when it comes to trust and confidence, I'm going to pick up on the conversation around long-dated government bonds. This fallout in demand for long-dated government bonds and the global phenomenon behind that, a lot of it is being traced to a general lack of security in the fiscal position of governments around the world. So a general lack of trust. And we've seen this breakdown in trust and confidence occur around not only the actual governments that are in situ, but some of the non-governmental positions that have been eroded or have been outright removed. And we can see a criminal investigation into the governor of the Fed, Lisa Cook, that's now been investigated by the Department of Justice in the US. So again, I mentioned before, this attack on government trust and independence, that is going to lead to a lack of confidence and a growth of uncertainty. Suggestion in an opinion piece in the Financial Times that what the market is really craving is credibility and stability. We've seen in the UK some scandals around Angela Rayner, another fiscal, another policymaker being accused of tax improprieties around a mortgage. It seems that residential mortgages are attracting a lot of attention, both sides of the Atlantic. So in her case, it was an underpayment of stamp duty relating to a second home. And then we've also seen the case of Nestle, and this is just picking up on other scandals that have been brewing throughout the private sector of CEOs losing their position over office liaisons. So again, the importance of confidence, trust, and proper behavior at every level of society is becoming more and more in focus, and something that we need not to underestimate in terms of its ability to undermine confidence in administrations and in status quo. Another factor of the lack of confidence in the fiscal situation is the demand for gold. We are seeing huge demand for gold, but silver and gold have doubled over the last 3 years in a bull run. And what we are also now seeing is the emergence of stablecoin as now suggesting they would like to tie their stablecoin to gold. Stablecoin has been tied to the dollar in the past. It has been seen as perhaps a way to bolster the dollar's reserve status, as the advantage of stablecoin is that if it's credible and trust is there, that's a key thing. We have seen some coins lose value in a spectacular way because they were not backed by hard currency. Stablecoin, if it is trusted, if it is backed by hard currency, it could be a way to shore up that currency's reserve status and equally to enable transactions in a much more reliable and efficient way on that. So that's stablecoin that is tied to the US dollar. But now we're seeing evidence that stablecoin and Tether in this case is looking to invest in gold. Gold is the ultimate real asset, the ultimate backstop, the ultimate assurance against currency debasement. So it'd be interesting if these two things are tied together, that this would be an interesting way in order to shore up confidence in that. So as we are now emerging from the summer and coming off the back of a Labor Day holiday, we are likely to be watching quite carefully for signs that some of the froth from the summer is likely to be dissipated. There seems to be on both sides of the Atlantic a fractiousness and a concern around the fiscal policies. So fiscal propriety is certainly in focus, and the move of governments around their tax and spending regime is certainly in focus. We see that investors are increasingly thinking flexibly about their asset allocation, whether that's to invest in inflation hedging assets and hedge that aspect, as well as thinking about gold and other ways of diversifying their currency exposure. What I would say overall is at Moneta, we have always been very focused on maintaining this diversified asset base as we enter an era of uncertainty, and with the reflections on the health of the US president over the Labor Day weekend, as well as the ongoing turmoil when it comes to governmental agency independence, it is more important than ever to have global exposure and to be invested across asset classes in order to maximize those diverse sources of return in the portfolio. We will be back next week with a special guest again, and we're going to be reporting in on the recent Argentine elections and getting a bit of perspective down there, as that is, as we mentioned before, a great laboratory when it comes to some of the fiscal pressures that we're seeing elsewhere in the world. Thank you for listening, and see you next week.